quite a fortune for himself, with a stock portfolio that includes bets on C Group, the parent company of Shopee and Nasdaq-listed Eastside Distilling. Mr. Seetoh's investment strategy is aligned to his own personal values, a cautious approach that focuses on well-managed companies over the long term. It's paid off with returns, he says, of about 30% a year.
So most of my wealth is in stocks right now. I think risk for stocks, right, is bad management or paying too high a price for stocks, or maybe the company has declining earnings or very weak competitive position. So the way I mitigate risk is by buying very high quality companies and companies that actually reports very high growth rate, because then the company will become more valuable over time.
Market uncertainty during the pandemic didn't deter small-time investor and student Alphonsus Yong from investing. The 20-year-old started at 16, executing trades back then through his father. He's now an undergraduate at the University of California, Berkeley.
One is more sort of like building up a very good safety buffer in terms of like my finances. Then second, it's more so of like dealing with issues of like wage stagnation and like the probability of me of maybe, you know, job insecurity that I could potentially face in the future.
Investing has its ups and downs, but Mr. Yong learned from his losses, and he's now maintaining positive returns.
My year-to-date gains are about 15%, but I also did face significant losses in the past, whereby a lot of these losses actually came from like not knowing what exactly I was getting invested into.
Risk is something retail investor Choi Ning-ying wants to avoid. So instead of direct investing, she puts her money in unit trusts or mutual funds.
So I used to buy shares. I got in I remember I have a share that's 20% steady growth, and there was a surge to 60%, but I didn't cash out in time and it dipped to negative 20%. So I realized that I'm not really suitable in trading stocks and shares myself.
She says her mutual funds give her exposure to tech, security, health and health science, along with some luxury brands. That diversification savvy investors say is key.
So as long as I diversify, as long as I dollar cost average in, right, and as long as I know and have done the research, and I'm able to hold for the long term. But of course, the most important is, I would say, not to go in blindly.
Financial consultant Heng Shao Ning says she's a risk taker, and for now, her strategy is working well. Over the last year, she's managed to score a whopping 60% gain in her portfolio.
I'm actually able to tolerate, I would say, about 20%, okay, paper loss. Well, I'm still quite young, so I don't mind waiting it out. I have a pretty long time horizon, so that definitely helps with the risk appetite.
Investment experts say market crashes can come out of the blue, with the causes only becoming apparent with hindsight in some cases. But with the global economy opening up, many experts have turned optimistic on the market outlook and believe there are limited catalysts for a major fall going forward. And to help us understand the risk and rewards of investing during the pandemic, we're joined by Lee Ken Soon, CEO and Fund Manager with Astral Asset Management. Of course, Ken Soon speaking to us this morning from Singapore. Very good morning to you, Ken Soon. So we are seeing that the stock market remains volatile as ever. So is it a good idea for investors to make an investment during the pandemic?